Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Palantir.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And just real quick, before we dive into today's analysis, I want to mention a highly useful chart tool for you guys. If you're looking for help reading trading charts more clearly, finding those setups, you can check out VIP Algos through the link below in the description.
Yeah, having clean charts is so important.
It really is. VIP Algos is a TradingView indicator suite, and it displays visual buy and sell chart alerts right on your screen. It's got trend direction tools, support and resistance zones, and take profit and stop loss planning areas.
And it works on pretty much everything, right?
Exactly. It's designed to work across multiple markets. So stocks, forex, crypto, gold, indices, futures, you name it. But, just keep in mind, VIP Algos is an educational chart analysis tool only.
Right. Very important to note.
Yeah, it is not financial advice. It does not place trades for you, and it certainly does not guarantee profits. Trading always involves risk, so be sure to manage your risk and do your own research. Also note that this is an affiliate link, meaning we may earn a commission if you use it at no extra cost to you.
Okay, with that covered, let's get into the situation with Palantir right now, because it's wild. Imagine a software company telling Wall Street its ultimate goal is to become like the foundational operating system for the entire United States military.
Right, a massive goal on its own.
And then somehow pivoting to put up the exact same level of dominance in the corporate boardroom. The company is demanding the entire market's attention right now because they're experiencing absolute hypergrowth.
Oh, absolutely.
And, the tension we have to resolve today is massive. Is this meteoric rally justified by a truly unbeatable business model? Or are we just witnessing another artificial intelligence hype bubble that's about to burst?
Yeah, and that tension is exactly what makes this analysis so critical today. Because the primary reason Palantir is taking up so much oxygen in the financial world right now is their staggering performance in the first quarter of 2026.
The numbers were just insane.
They really were. I mean, they posted 85% year-over-year revenue growth. But rather than just letting those numbers speak for themselves, their CEO recently went on a very public offensive.
Oh yeah, Alex Karp did not hold back.
Not at all. He aggressively called out rival artificial intelligence labs, questioning the security of their business models. And it has created this massive wave of momentum. It's really forcing the market to decide if they're buying a fundamentally superior business or, well, just chasing a charismatic narrative.
Well, let's move into the wealth building context, because we need to understand what this company actually does day to day. For a long time, the prevailing narrative was that Palantir was basically a black box.
Yeah, very secretive.
Exactly. They were viewed as this highly specialized, somewhat secretive defense contractor building surveillance and data analytics tools for intelligence agencies. But the wealth building thesis today hinges on a massive transformation.
They aren't just selling to the Pentagon anymore.
Right. They are rapidly shifting into a dominant commercial enterprise AI player.
And, the underlying shift here is all about corporate paranoia. In the best possible way, I mean. U.S. commercial revenue just jumped 133%.
Wow, 133%.
Yeah, hitting $595 million. That is a massive inflection point. I mean, they crossed 100% growth in U.S. revenue for the first time as a public company.
That's huge.
What that tells us is that widespread enterprise adoption is happening right now. Corporations are looking at the landscape of open-source chatbots and public AI tools, and honestly, they're terrified of feeding their proprietary data into them.
Wait, I have to push back here a little bit to see if this is real. When you see triple-digit growth in a single segment like commercial software, the immediate question is whether this is a foundational growth stock or just a speculative play riding a broader AI wave.
That's a fair question.
Because right now, every company on the planet is slapping the AI label on their products to boost sales. What makes this any different than, say, a company just integrating a flashy public language model into their workflow?
Well, the difference comes down to data sovereignty. The data strongly suggests this is a foundational growth stock for investors who believe that enterprise AI integration requires strict military-grade data security.
So walled gardens, essentially.
Exactly. Corporations are quickly realizing that just playing around with open source models isn't going to cut it for their most sensitive operations. If you're a massive bank or a healthcare provider, you cannot risk your internal data leaking into a public training algorithm.
Right, that'll be a disaster.
You need AI that is deeply integrated but securely walled off, and that is the specific bottleneck Palantir is solving.
So we know they're locking down these massive enterprise contracts by selling an entire secure infrastructure. But, massive revenue doesn't always equal massive profits.
That gives us the bigger picture. Now let's look at the fundamentals, because in the tech world, it's incredibly easy to buy revenue by just, burning through venture capital.
Right, the classic cash burn strategy.
But the fundamentals here are where the story separates from the rest of the pack. Diving into those Q1 2026 numbers proves that Palantir is incredibly profitable today, not just hoping to make a dime a decade from now.
So what are we looking at for the top line?
Top line revenue hit $1.633 billion. That's what drove that 85% year-over-year growth. But the true standout is their operating margin, which sits at a massive 46%.
Wait, 46%. Let me stop you there. Because a 46% operating margin is almost hard to comprehend for a company scaling this fast.
It's unheard of for most.
And the fact that it's GAAP operating income is crucial. That means it's generally accepted accounting principles. Real audited profit, not just adjusted, make-believe tech numbers where companies hide executive stock compensation.
Right, exactly. Real dollars. It translates to $754 million in GAAP operating income for a single quarter.
But how do they actually achieve a margin that high? I mean, software is scalable, but that's extreme.
It really comes down to the scalability of their specific software architecture. Palantir invests heavily upfront in what they call forward-deployed engineers.
So people who actually go sit with the client.
Yes, to integrate the system custom to their needs. But once the foundational software, their platform, is installed, the cost to deploy it to the next 1,000 users at that company is basically zero.
Oh, wow. So the initial lift is heavy, but then it's pure margin.
Exactly. That allows the profit margins to expand rapidly as client usage grows. Add to that their free cash flow, which hit $925 million. That's a 57% cash margin.
That's a ton of cash generation.
And structurally, the balance sheet is basically a fortress. They carry zero debt.
Having zero debt in a high-interest rate environment is a massive strategic advantage. It means every dollar of that free cash flow can be used for research, acquisitions, or returning value rather than, bleeding cash to service bank loans.
And when you synthesize all of those metrics, their Rule of 40 score is currently sitting at an unbelievable 145%.
I hear the Rule of 40 thrown around a lot in tech analysis. But let's break down what that actually measures for everyone. It's essentially the revenue growth rate plus the profit margin, right?
Yep, that's the formula.
So if a software company grows at 20% and has a 20% profit margin, they hit 40, which is supposed to be the benchmark for a healthy business. Being at 145% is just absurd.
It really is. It puts them in an elite tier alongside hardware monopolies like NVIDIA.
Right. But, the metrics only matter if the business is defensible, which leads to the obvious question. What stops competitors from just reverse engineering this and stealing their massive corporate clients?
That's the million-dollar question.
If the market is this lucrative, why doesn't another tech giant just build a secure wall around an AI? What is their actual competitive moat?
Their competitive moat is a proprietary application layer they refer to as the ontology.
Okay, let's unpack that. Because ontology sounds like a philosophy term. What does it actually do mechanically?
Think of the ontology as the translation and security layer between raw artificial intelligence, like a large language model, and the highly regulated, sensitive data of an enterprise.
Okay, I'm tracking.
Most competitors rely on what we call token-based models. When you use a normal AI, it chops your data up into pieces called tokens, sends those tokens out to a massive cloud server, runs the math, and sends an answer back.
And the inherent risk there is data leakage, obviously.
Exactly. The ontology prevents those models from caching customer data, replicating business secrets, or transferring intellectual property back to third-party labs.
So it's kind of like a clean room in a highly secure laboratory. The AI is allowed to put on a hazmat suit, go inside the room, and do the complex analysis on your company's proprietary data.
That's a great analogy.
But when the AI leaves, the ontology strips it down at the door.
Yeah.
It takes absolutely none of your secrets back to the public web.
That is a perfect way to visualize it. And that mechanism creates massive switching costs for the client. Token-based models from public labs face inherent friction in classified environments because the enterprise simply cannot stomach the risk of their blueprints feeding a public algorithm.
Right, the risk is just too high.
Once a massive corporation integrates Palantir's ontology to protect their data, ripping it out to try a competitor's newer, untested system is a risk they are almost never willing to take.
That gives us the business picture. Now let's move to the catalyst timeline. to see what events could actually drive the price action in the near future.
Building on that fundamental strength, there are three key catalysts on the immediate horizon. First up is their August 2026 earnings report.
Which is coming up fast.
Yes, and this event is highly anticipated because management took the aggressive step of raising their full-year revenue guidance to over $7.65 billion.
Whenever a management team raises guidance like that, they're essentially walking a tightrope. The market expectation gets dialed up to 11, meaning they don't just have to do well, they have to beat their own new higher bar.
Right, there's very little room for error. The second major catalyst revolves around the continued rollout of their sovereign AI operating system. This is a joint architecture they announced on June 29th in partnership with NVIDIA.
Let me clarify what a sovereign AI actually means in this context. We're talking about an air-gapped AI stack, right?
Yeah.
A system built with NVIDIA's hardware that is completely physically disconnected from the public internet. No outside servers, just a closed loop.
Precisely. It validates their strategic partnership with the unquestioned leader in AI hardware. Palantir is providing the software brains to NVIDIA's brawn.
That's a powerful combo. What's the third catalyst?
The third one involves some persistent, though unconfirmed, rumors circulating in the defense sector. There is heavy speculation that unspecified government agencies are actively transitioning away from proprietary, token-based AI models and moving strictly toward these closed Palantir and NVIDIA architectures.
Man, if that's true, it points to a massive macro rotation in the market. We're seeing capital flow out of the expensive AI hardware and semiconductor names. The companies building the picks and shovels and rotating into AI software, the company's actually finding the gold.
It's a huge tailwind if it plays out.
But let me play devil's advocate. When we talk about catalysts like this, we have to caution you against fake timing confidence. Is this macro shift already priced into the stock? Just because an earnings report is coming in August doesn't guarantee a pop.
You have to approach catalysts with a level head. A known catalyst is often a priced-in catalyst. The market is forward-looking, so if everyone expects a massive beat in August, the current price already reflects a good portion of that optimism.
Catalysts tell us what could change the story. Now let's pivot to the chart.
Looking at the recent price action, Palantir has been trading around $129.35, and the momentum has been fierce. The stock rallied nearly 20% in a span of just 5 days.
A 20% move for a company of this size in a single week is explosive. What was the specific trigger for that run?
It directly followed a very high-profile CNBC interview where CEO Alex Karp went on the attack. He specifically criticized the token pricing models of those frontier AI labs we talked about earlier.
Oh, right.
His argument to the public was that enterprises are essentially paying these labs to lose their own competitive edge by giving away their intellectual property. The market absolutely loved the aggressive, combative narrative.
That's a brilliant soundbite, and it clearly moved the needle by drawing a line in the sand between secure AI and vulnerable AI.
It did. But here's the technical context. Despite this massive recent surge, the stock is still trading well below its 52-week high of $207.52.
It's a pretty wide gap.
Yeah, and analysts over at D.A. Davidson see this gap between the current price and that 52-week high as a prime entry point. Their core argument is that the company's profits and margins have absolutely soared over the last year, but the price hasn't fully reclaimed its previous highs to reflect that new, highly profitable fundamental reality.
So the chart gives us price structure. But what does market sentiment look like? I need to ground the conversation here, though. While the fundamentals look stellar, charts show probabilities, not guarantees. A gap to a 52-week high doesn't mean a stock is magically obligated to fill it.
Absolutely true.
A chart doesn't care about a company's profit margin. It reflects buying and selling pressure. This is exactly why traders use tools with support and resistance zones to plan their risk. You have to understand where your downside is, regardless of how bulletproof the fundamental story sounds.
Structure and risk management are paramount, especially with a stock moving this aggressively.
So moving on to the sentiment, who is actually doing the buying?
Sentiment right now is overwhelmingly bullish across the board. The market perception is functioning as a massive tailwind. You have high-profile commentators like Jim Cramer recently going on record calling Palantir the fastest grower in the space.
The kind of loud public endorsement definitely acts as a megaphone for retail investor interest.
It brings a lot of volume, but institutional money is lining up as well. D.A. Davidson recently upgraded the stock from neutral to buy, raising their price target to $175. And the broader analyst consensus sits even higher, right around $182.75.
So the institutional side is essentially agreeing that the stock has significant room to run based on the new guidance and commercial adoption.
Yes. And beyond analysts, there is some fascinating insider flow-making headlines. According to a 2025 financial disclosure, President Trump holds at least $1 million in Palantir shares and recently added to that position.
Oh.
Yeah. And, we are looking at this strictly impartially as raw market data, but anytime a major political figure discloses adding to a significant position in a defense contractor, it feeds heavily into the broader bullish narrative regarding future government contracts.
Oh, it definitely pours gasoline on the hype cycle.
The other side of that sentiment equation is how the CEO's aggressive narrative is functioning as a driver all on its own. Calling out competitors directly on television is galvanizing both retail and institutional investors who want to back a clear, combative winner in the enterprise AI space.
I really have to question if this sentiment is getting a little too frothy, though. When everyone is overwhelmingly bullish, analysts are upgrading targets, and the CEO is essentially declaring victory over open-source models on national television, you run the risk of setting expectations so impossibly high that even a genuinely great quarter is viewed as a disappointment.
That sentiment picture is useful, but we still need to talk about the risks. Because no stock goes straight up forever without facing reality.
Let's balance all this extreme optimism and look at the bear case. What does the downside actually look like for a company executing this well?
The downside focuses almost entirely on valuation risk. No matter how much we love the 46% margins or the pristine balance sheet, we cannot ignore how expensive this stock is right now.
How expensive are we talking?
Palantir currently trades at a forward price-to-earnings ratio of 80.
An 80 forward PE is incredibly steep. You are paying a massive premium for future earnings that haven't even happened yet.
It gets heavier when you look at revenue. The price-to-sales ratio is 54. To put that in perspective, if we compare Palantir to the absolute king of AI infrastructure, NVIDIA, the company physically building the chips powering this entire revolution, NVIDIA trades at a forward PE of just 23.
Wow. So relative to the hardware monopoly of the AI world, Palantir is wildly expensive. A price to sales of 54 means you're paying $54 for every single dollar of sales the company makes before they even pay a single employee or server bill.
The danger of valuation that high is the severe risk of multiple compression.
Let's make sure everyone understands exactly what multiple compression means, because it is the monster under the bed for growth investors. Right now, Palantir is priced for absolute perfection. They are walking a tightrope.
A very thin tightrope.
Multiple compression means if they miss their revenue goals by even a fraction of an inch, the market doesn't just tap the brakes, it pulls the parachute. The market will reprice the entire valuation multiple downwards, meaning the stock price could collapse by 20% or 30%, even if the underlying business is still technically growing and making a profit.
And we have historical precedent for this specific stock acting that way. Palantir has been crushed in the recent past despite posting strong growth numbers. It shows an extreme vulnerability to broader market sector rotations.
Exactly.
If the market suddenly decides that AI software multiples are too high across the board, Palantir will drop, and the market won't care about their zero debt or their clean room ontology.
I really want to emphasize this point for you. Perfection is fully priced into an 80 PE. There is zero room for execution errors. If commercial adoption slows down by even a few percentage points, that valuation will act like an anchor.
While the underlying business quality is stellar and the moat is as wide as it gets in software, you have to acknowledge that the current valuation leaves absolutely no margin of safety.
So with everything on the table, what's the final verdict?
Based on the fundamental data, the rapidly expanding commercial moat, and the massive margin expansion proving the software scales beautifully, the bullish score for Palantir is a 9 out of 10.
A 9 out of 10. That is an incredibly strong conviction rating.
It is. The final verdict is that Palantir is currently the premier way to play the enterprise AI revolution. They are showing flawless execution, and they are solving the exact data security problems that massive corporations are facing today.
And what's the time frame on that?
As for the target horizon, this is fundamentally a multi-year horizon. The thesis is built on the durability of their sticky government contracts combined with that expanding commercial adoption. They aren't just selling software anymore. They are becoming the secure operating system for enterprise data.
Just a reminder as we wrap up, we are analyzing a high-risk, high-reward stock today. This is an incredible growth story with a very demanding valuation, and everything we've discussed is strictly analysis, not financial advice. You have to consider how multiple compression risks and your own time horizon fit into your portfolio strategy.
It's a powerful story with phenomenal execution, but the price tag is undeniably premium.
And if you want a cleaner way to read trading charts to help manage that risk, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite featuring visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas.
Yeah, it's super helpful.
It is designed to help make charts easier to scan. But remember, it is only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it absolutely does not guarantee results. Trading involves risk, so always do your own research and manage your risk carefully. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.